Welcome everyone to the April 2020 Energy Finance Discussion Group in webinar format. This might be the first time I think it's been hosted this way as opposed to a breakfast. As I said before, my name is Brett Cunningham with Riveron. Andy Logan and I worked together to put this webinar together, and he asked me to introduce today's speakers. Before I do that, I'd like to give a quick shout out to Energy Finance Discussion Group sponsors BKD and Moss Adams for their continued support of the group. A few housekeeping items. Andy's working with next month's presenter to see if we can host another online event. The tentative date for that is May 12th currently. So please keep an eye out from an email from Andy with more details on May's Energy Finance Discussion Group. And hopefully we'll be able to get together in June in person for a breakfast again, but maybe not. A few key reminders here. So, we're using Zoom as the platform here. They've had a lot of high demand and technical difficulties. Hopefully we don't experience any of those during this presentation, but please bear with us if anything occurs. We're going to have all participants muted for the duration of the presentation. So please keep yourself muted throughout to limit any interruptions. If you have any questions, please feel free to use the chat feature, which I will send a note to everyone right now. To ask questions. After the presentation, we'll send out a recording of the webinar and the contact information for our two presenters today. Just a quick housekeeping item. This presentation represents our personal views and should not be taken with as any financial, legal, or tax advice, and is for educational purposes only. That said, I'd like to introduce our two presenters today. Damon Cade, a managing director with Riveron, who has 21 years of experience in both advisory and industry capacity and spans upstream energy, power, and manufacturing industries. He has substantial expertise transforming both healthy and challenged companies, developing operating models, leading corporate functions, and implementing actionable business plans. David has vast experience with executives driving strategic level initiatives and the P&L level implementing real-time operational improvements. Dan Johnson, a managing director with Conway Mackenzie, a part of Riveron, has more than a decade experience advising public and private companies, corporate boards, special committees, financial sponsors, lenders, and creditor committees, primarily in the energy industry. Financial advisory experience spans interim management, valuation, liquidity, and cash management, balance sheet recapitalization and restructuring, preparing projections and business plans, business optimization and transformation, DIP financing, and bankruptcy preparation. With that, I'd like to give you a quick overview of the agenda today. We're going to do a quick market update, energy bankruptcy landscape overview, 101 of bankruptcy, practical considerations for distressed energy companies, planning the business for reorganization, and at the end of the presentation, we'd like to open it up for some Q&A through the chat application within Zoom if you'd like to submit your questions there. That said, I'd like to hand it over to Damon to cover our market update.
Hey, good morning. This is Damon Cade. I hope you all are well. Love to do this in person sometime down the road, but this is the new normal, at least temporarily, right? So what we'd like to cover here is a little bit of market, things that happen in the market specific to the upstream side of the cycle. Obviously, we've had a price war going on, and some of this information is dated. Everything is constantly moving. The price cut or the OPEC cuts were announced a few days ago. So some of these slides are as of middle of last week. But obviously, there's a large price war with OPEC, Saudi, and the Russians. that has somewhat worked itself out. You know, the Saudis, from their point of view, they moved production from 9 to 12 million a day. They could go up to almost 13 a day during this price war because, you know, the folks in Russia did not want to cut. They also had some, you know, larger price cuts as well that triggered this downward spiral in the oil commodity pricing. So, you know, 50% to $26 a barrel. I think today we're at 21. You know, a few days ago we were at 28. So the volatility is moving quite a bit right now. There's a lot of triggers, a lot of levers, obviously going on. Not only the price war, which was somewhat triggered by COVID, but we have, you know, a major shift in folks and how they're investing going forward. So these are a few of the factors: the price war, COVID, and the shift to ESG that we're seeing that, you know, impacting our industry. I have, you know, living in Houston, I spent quite a bit of my time in upstream energy, both E&P and oilfield services. I ran a small E&P company in my past, and you know, we'll talk about some of the things that we're seeing here on the next slide. Brett, if you would go to slide 8, there you go. So obviously, this price war, the COVID, and many of the investment shifts, triggering a number of challenges within the industry. You can see some of these recent headlines and folks that are filing over the last week or so. I think yesterday or this morning, Hornbeck, which is a offshore logistics provider in the Gulf of Mexico, they filed for Chapter 11. We're going to probably see a heck of a lot more of these happening, especially in the oilfield service space to begin with. At least that's what we're seeing in the marketplace. I'll touch on more of what we're seeing in the marketplace from our client network, from our from the investor network later on. I won't quote who we're getting this information from, but, you know, one quote out there saying, you know, their company, which is an oilfield service company, is at DEFCON 1, which is, you know, very, very distressed at this point. And we're seeing some of our companies, past clients, go from Chapter 11 to liquidation in a matter of weeks just because their business is just not viable at this point in the current environment, and liquidity is just so constrained. So we'll talk more about that later on in the presentation. If we go to slide 9, let's talk about some of the oil supply and demand economics that are going on. Obviously, we're in an oversupplied market. I read somewhere today that even with the cuts, let's just call it 10 million with OPEC in the U.S. all combined, we're still in a very oversupplied state. I read, you know, total, even before the cuts, we're around 30 million barrels a day in oversupplied state because of COVID and the industrial shutdowns across the world. Obviously, the airlines and logistics not consuming the hydrocarbons. So if you look at the forecast there at the bottom of the graph, the historical forecast of growth, you can see it in 2020, it's negative at this point in terms of supply per day. It's probably much lower than that, or going much lower than that from a global oil demand here in the first couple quarters of the year. But this is, you know, information from IEA. We're also seeing global, stay on that slide, sorry. We're also seeing a very oversupplied market up in the upper right-hand corner, as you can see in the graph, which trends to WTI. Obviously, you see price jumps in undersupplied markets. So, like I said, today we're about $21 a barrel WTI this morning, even with the agreement being announced the other day. Last thing here on this slide that's important. U.S. has been exporting, obviously, in the last couple of years, crude at a higher rate. Obviously, you know, 5, 6, 7 years ago, we didn't export any. Now the United States is the largest oil producer in the world, and we're exporting about 25% of our current production. So that's obviously going to be impacted by this economic downturn that we're seeing with both COVID and with the commodity price. Let's go to the next slide. Gas prices, from my point of view, I'm sorry, got ahead of myself. Oil and gas price forecast. This is mostly the WTI forecast. We'll talk about natural gas here. You can see the forecast here from Bloomberg is pretty flat over the next couple years. This is one firm's forecast. The truth is, I think that's a really conservative guess. I think things could go much further downwards before it goes upwards here into the teens, unfortunately. But the forecast is not very good, at least from commodity prices, where $40 barrel oil is not producing much in terms of rate of return. And that goes without saying. Obviously, in the low 20s, mid 20s, it's negative for some. I know one offshore producer, their break-even cost is about 20. Not break even, but their cost to produce all in is about $23 a barrel. So in this market, it's very challenging for them. They're having to weigh in just shut-ins right now and paying the penalties on take or pays, and it's much more economic, unfortunately, than producing at this point. Let's go to the next slide. So this is oil exploration production activity. Really the whole point of this entire slide here is obviously CapEx revisions are in play right now for a number of companies. Again, this goes without saying, if you're not mid-flight within a project, if you're not tied up, or if you can't get out of kind of your rig contracts or some other construction EPC work that's going on, you're going to be going and cutting CapEx. Just looking at Baker Hughes rig count this morning, this is hot off the press. We're 41% US, down year over year. I think rig count is at 602 according to Baker this morning. I think Texas has or Permian Basin has about 320 of those rigs running, so more than half, and that includes obviously New Mexico. International rig count, which is not on this graph, has remained pretty steady. Obviously, those folks out there have multi-year tenders with their oilfield service providers. So that rig count's about 1,059 this morning. This isn't on the graph here. It's actually up 2% year over year. Again, we're not going to be able to see the quick reaction in the market for them because of the multi-year tenders. But this graph here is focused purely on U.S. Rig activity and drilling by basin. Obviously, Permian is the leader, like I said earlier, with about 316 to 19 rigs running currently. Let's go to the next slide. So natural gas is the slide I skipped to earlier. From my point of view, this is pretty steady. There's a lot of take or pays already in the market from a natural gas point of view. Obviously, depending where you are, if you're closer to LNG, prices will be, different than folks that have a lot of, in terms of profits, a lot of TNT or a lot of transportation to move their gas across the country. But this, from my point of view, gas is staying pretty steady. Into the right now, I think we're $1.66 this morning when I looked at it, around that $2 range, $2.50 range, at least the Henry Hub forecast here for U.S. Energy Information Administration and Bloomberg. So that's their forecast. Really, gas hasn't moved too much in the last couple of years, and I think, unfortunately, we'll probably see such similar flat curve with oil in the coming future. Let's go to the next slide. So here's kind of the meat on the bone, if you will, within the oil and gas market. Obviously, acquisition divestiture market has dried up quite a bit, at least at this point in the year. Most of the deals that we've been seeing, we do a lot of transaction services, sell side, buy side due diligence work within Riveron. That has almost come to a halt here in the first into the first quarter, beginning of the second quarter. And quite frankly, that goes to that's just not oil and gas. That's most other industries as well. But obviously, oil and gas has got the double whammy here with the commodity price and COVID going on at the same time. So that's unfortunate. So that's dried up the transaction market. The second and third point here both deal with more distressed situations. We're seeing a lot more bankruptcies obviously pick up right now. And obviously one strategy is to do what they call a 363 or stalking horse. You'll hear that terminology quite a bit, where it's a prepackaged arrangement to sell assets, and you leave most of the debts and the liens and all that with the remainco, if you will. So we're seeing those start to pick up. I'm seeing some just flat out liquidations at this point going on where businesses can't even survive, and it becomes just roof line and machinery and any sort of inventory sell, just because the business was already somewhat distressed even going into this environment that we're in. And then obviously deal values are going way down. If you see the two graphs there, that the average deal value is way down from 19. And then you see the count, like I said earlier, is way down from the average that we're going into from 19. And you see bankruptcies. I expect this trend to pick up quite a bit more here in the next couple of weeks, especially in the second quarter. Obviously, the deal values are down. Obviously, the valuations are lower, and the counts are starting to pick back up. If you can see, we're already at 12 versus 11. 363 bankruptcy sales from the prior year, and I expect that to probably double here in the next 5 to 6 weeks. I think we're going to turn it over to Dan now, and he'll give you a little bit more color here on the energy bankruptcy area.
Thanks, Damon. This is Dan Johnson. I'm a managing director in the Recovery and Transformation Services at Conway Mackenzie. I'm going to dive in here and discuss more specific distressed energy companies and distressed bankruptcy. So the energy industry and energy companies face unique challenges that drive idiosyncratic challenges specific to energy companies. These, the volatility of commodity prices not only impacts top line revenue, but can also act as a double punch in that reserve-based loans will be redetermined lower, driving reduced liquidity and capital to fund CapEx, and also result in deficiency payments that often drive companies into bankruptcy. Depleting asset bases require, continual CapEx to expand and maintain the operational footprint. Another area is non-op interests and non-op partners have little control over costs and production decisions that potentially drive liquidity issues. And finally, plugging and abandonment obligations or P&A obligations can mount as more wells become uneconomic, requiring additional funding for P&A or increase in financial assurance, including bond and LC premiums. All these factors combined really drive issues specific to energy companies that often result in energy companies restructuring outside of court or in court. And next slide, Brett. So the bankruptcy landscape. So what we've seen in the years following the 2015 oil price crash was a multi-year period of increased E&P filings, as you can see in this graph. Over that 5-year span, we've seen over 200 cumulative filings. Filings slowed in 2017 and 2018, but we have seen a recent uptick in activity in 2019 due to sustained low oil prices, a lackluster A&D environment, and also reduced global demand in 2019. We expect the current oil price war combined with reduced demand due to economic contraction resulting from COVID-19 to accelerate E&P filings beyond what we saw in the years following 2015. Next slide. As you can see on this visual, filings by state, looking at the filings by state, we observed most filings in Texas, followed by Delaware. Both have become very popular and sophisticated venues in recent years since the 2015 oil price crash for energy company bankruptcies, both E&P and OFS. Interestingly, Colorado ranks number 3 as far as a filing venue, and we also expect this trend to continue through this upcoming wave of expected bankruptcies. On the OFS, in the OFS sector, it's not surprising that oilfield service companies have also followed a similar trajectory as the E&P sector since 2015, with cumulative OFS filings also nearing around 200. a typical pattern emerges when commodity prices fall, and we see that in these bankruptcy filings, OFS filings will lag a few quarters behind E&P filings due to the correlation among the two subsectors. As commodity prices fall and wells become uneconomic, E&Ps reduce their CapEx budgets. In turn, the top line for OFS companies start to see a lag. And interestingly, the midstream segment has stayed somewhat insulated during and after the 2015 oil price rout. Several factors are attributed to this phenomenon, including fixed price contracts leading to steady cash flows, lower cost of capital, and easier access to capital markets due to the MLP structure. OFS filings by state, as you can see, very similar to E&P filings. Texas has the most filings, followed by Louisiana and Delaware behind. So Bankruptcy 101, I want to give a brief overview on essentially what Chapter 11 is, how it differs from Chapter 7, and some of the key elements of bankruptcy. So Chapter 11 is at its basic core is a process whereby a debtor company can reorganize its debt through a court-supervised process, affording it the tools and protections that come along with federal laws associated with bankruptcy, which we'll get to later in the deck. While Chapter 11 allows a debtor in possession to continue operating their business to reorganize, how that differs from Chapter 7 is that Chapter 7 is a liquidation process, as Damon mentioned earlier. This process of a Chapter 7 is supervised by the court and controlled by the direction of a Chapter 7 trustee, which is appointed by the court. And essentially, their duty is to sell the assets as quickly and as efficiently as possible. So some of the core principles of modern Chapter 11 restructuring. So Chapter 11 have several core principles that benefit both debtors and creditors alike, and that is the main goal of the bankruptcy code. The automatic stay essentially puts a legal halt on any creditor's collection efforts, lawsuits, or creditors from taking action on their debt. This gives the debtor breathing room to operate their business and reorganize their company in a organized and planned out manner. Companies, boards, and management teams typically remain in control and operate during the pendency of the Chapter 11 proceeding. This is what's called the debtor in possession. Companies exit through a plan of reorganization, and the goal of the plan is to maximize value to all stakeholders. Once a plan is confirmed, creditors receive their distributions under the plan, and all other debts are discharged unless specifically addressed in the plan of reorganization. Next slide. So here are a few of the primary types of bankruptcies. So when some people think of bankruptcies, most oftentimes you think it's a crisis situation, unplanned, but very rarely do companies file bankruptcy unplanned. And this table illustrates the various types of Chapter 11s. So the first type here is what's called a prepackaged plan or a pre-pack, as they're referred to. And these are usually fully baked reorganization deals with more than 67% of impaired creditors in favor of the deal before filing. Typically, these are debt for equity conversions where the creditors take the keys and the trade creditors or the vendors ride through essentially unimpaired. These are the shortest duration cases and are typically in and out of bankruptcy in less than 3 months, and sometimes as little as 2 or 1 month in bankruptcy. Prearranged bankruptcies is the next bankruptcy on this list. These are very similar to pre-packs, but in these situations, you may not have all 67% of the creditors essentially on board with the plan prior to filing. However, the deal is pretty substantially baked and negotiated going into bankruptcies, and these usually ride through and are out of bankruptcy within 4 to 6 months. Confirmation is slightly riskier because you solicit votes without knowing the full extent of the creditors that are on board with the deal. The next type is what's called a free fall. This is probably what a lot of people think of bankruptcies is they are where the stakeholders cannot agree on a deal or a plan before going into bankruptcies. the company is forced to file to bring the parties to the table, and it's forced to file out of necessity in many cases. These cases typically spend a longer time in bankruptcy as there are competing stakeholder groups negotiating, and oftentimes a creditor committee will form of unsecured creditors, and an equity committee may get appointed as well in these situations. These situations will also have litigation and disagreement on valuation between the various groups, and other nuances. Unplanned filings are actually fairly rare. These are situations when a company is forced to file abruptly, and possibly something catastrophic happens, something macroeconomic like what we saw in 2008 and 2009 with Lehman Brothers and Washington Mutual, or just recently Philadelphia Energy Solutions with their refinery explosion really drove them into essentially an unplanned situation. So getting into some of the primary tools of bankruptcy that a lot of debtors use to reorganize their business, one of the most popular tools that's really used and that a lot of people are aware of is the ability to reject leases and executory contracts in bankruptcy. This tool gives companies tremendous leverage over landlords and contract counterparties to bring them to the negotiating table. It also allows companies to shed unprofitable contracts or leases that were negotiated in times of economic prosperity, and now the downturn has caused lower prices, and contracts and leases are unsustainable. So this is a very popular and very powerful tool that is used very often in bankruptcy. 363 sales. So this is how you sell a company or assets in bankruptcy, and we do see 363s sales are very common, especially in modern bankruptcies. Selling assets or the entire company in bankruptcy is referred to as a 363. This refers to the bankruptcy code section governing the sales. The process, we've laid out essentially a format or a template of the process, and this usually begins with hiring a broker or investment bank to widely or broadly market the assets, typically pre-petition if the bankruptcy is planned, or if the bankruptcy is unplanned or a little more abrupt, then the marketing process can take place inside of bankruptcy after the petition is filed. Once a lead bidder is selected, that's referred to as a stalking horse bidder. The stalking horse bidders provide certainty of a sale in bankruptcy. It also gives the stalking horse certain bid protections, and such as breakup fee, expense reimbursement, and this also creates a competitive dynamic to bring other bidders to the table. Once the stalking horse is selected, with bid procedures, an auction is held, and the winning bidder is selected. One of the key components of a 363 sale versus a sale outside of bankruptcy is that the assets are sold free and clear of liens and encumbrances as the title passes with the proceeds of the sale. This makes 363 sales specifically attractive to potential buyers, as there is essentially no unknown liability overhang in purchasing assets out of bankruptcy. So the two key elements or legal documents to confirm Chapter 11 plan is the plan of reorganization and the disclosure statement. The plan of reorganization lays out the various claims and treatment of each creditor's claims under the bankruptcy, and this really essentially is a contract between the debtor and the creditors. The other key document is the disclosure statement, which details all the information necessary for stakeholders to cast an informed vote. It details items such as expected creditor recoveries and compares this to what they would receive in a hypothetical Chapter 7. Our team very often helps draft and plan and develop plans of reorganization and disclosure statements for companies in bankruptcy. So practical considerations for distressed energy companies. These are we've laid out several key areas that we're seeing in modern energy bankruptcies. The first consideration is midstream contracts. So one of the primary questions that we're asked is can we reject our unfavorable midstream contract in bankruptcy? And the answer is it really depends. So shedding, essentially shedding debilitating minimum volume commitments and above market rates is sometimes necessary for the survival of any E&P post bankruptcy, and why many turn to this tool to force their midstream contract counterparties to the table. And the threat of bankruptcy will, oftentimes will bring contract counterparties to the table, but often other times they're reluctant and essentially hold out. And so sometimes you can use Section 365 to attempt to reject a contract in midstream contract in bankruptcy. So the one nuance with midstream contracts is that there's certain provisions that can create what is known as a conveyance of real estate interest, which is essentially outside the purview of Section 365 of the Bankruptcy Code, and therefore cannot be rejected. Midstream contracts oftentimes contain acreage dedications, and when constructed properly and filed in the county of record, can be considered covenants running with the land and therefore not be rejected. So there's a few cases we've listed here. The first of which is Sabine, and this was back in 2016, and this really became kind of the gold standard on assessing whether we can reject a midstream contract in bankruptcy. In the Sabine case, they applied Texas law. It was a New York bankruptcy case, and essentially concluded that the midstream contracts were executory contracts and you could reject them in bankruptcy. And the rejection damages just become an unsecured claim, and under the plan, and you can either renegotiate or find an alternate midstream provider. However, a few recent cases, the Monarch Midstream versus Badlands production here in Colorado, the midstream contract was considered that it had covenants running with the land and essentially could not be rejected in bankruptcy. And also, very recently, Alta Mesa case had another midstream issue and litigation, and the midstream contract in that case it had certain acreage dedications that were properly perfected and determined to be covenants running with the land, and also could not be rejected. So in conclusion, midstream contracts are a very hot issue, especially in modern E&P bankruptcies with minimum volume commitments and above market rates, and planning, very careful planning and crafting needs to be devoted by both midstream companies at risk and E&Ps considering how to shed unfavorable contracts. Another area that we see a lot in E&P bankruptcies is mechanic and materialmen's liens on properties. These are referred to as M&M liens. These, as cash-strapped companies start to stretch AP, and vendors will attempt to perfect a lien on the well and lease. Contractor liens attach to substantially all the assets of the leasehold where the work is performed, and are typically equal or senior to the claims of the secured lender. And this becomes a point of litigation contention among the M&M lien claimants and secured lenders in bankruptcy. And these liens will prevent a company from selling assets outside of bankruptcy that they can, and the M&M lien holders can assert legal influence over the debtor. And this is really an issue. So as liquidity is constrained, one area of both ordinary course and outside ordinary course business is to sell non-core assets to shore up liquidity, and these liens, once these liens start getting attached, it really prevents you from selling those assets without either paying off and negotiating with the lien holders or filing bankruptcy and shedding them through the bankruptcy code. Our team deals a lot with M&M liens and strategies to avoid M&M liens while still managing liquidity. And this is important as you think about a restructuring solution. These M&M liens can reduce options available, as I mentioned, for both out-of-court turnarounds, and bankruptcy may be the only way to shed the liens. So suspense funds or revenue suspense, and this really refers to what we refer to here as the age suspense balances that are old and not in pay status, and we see this a lot with middle market and lower middle market E&Ps. Suspense affects organizations large and small, but we really see liquidity issues develop among the middle market E&Ps. Oftentimes, distressed upstream companies will have underfunded or aged revenue suspense balances that they are unable to fund or even meet the state escheatment requirements. Now, there are various treatment options available with revenue suspense, mostly available in bankruptcy, and I'll touch on a few key points. The automatic stay of bankruptcy will halt the requirement to sheet funds to the state. So if a distressed E&P is unable to make their escheatment requirements and has an upcoming escheatment, proper timing of a bankruptcy filing, you can halt that requirement to sheet funds to the state. In bankruptcy, if these interest owners, these aged interest owners, and that you're unable to find lost at bad addresses and title issues, if they don't show up to file a claim properly in the process, these suspense claims are essentially extinguished under the bankruptcy, and the funds that are then available for use by the estate. Lastly, selling assets in bankruptcy that have a significant suspense balance, the assets will typically be sold free and clear of the age suspense. This makes sales of assets in bankruptcy under 363 very attractive for buyers. And finally, I want to point out that treatment can vary state by state, so coordinating with bankruptcy counsel that has specific expertise in this area is critical before making strategic decisions regarding your revenue suspense balances. All right, next. A few other considerations specific to energy companies that we see. A very common and modern operating structure among sponsor-backed and middle market E&Ps is the OpCo/PropCo structure, whereby one entity will be set up to own the oil and gas assets, hold the debt, but have no employees. The employees are housed under an affiliated operator entity that charges the oil and gas company a service charge for G&A under a master services agreement or MSA. Well, what we're seeing, recently is that this structure has come under fire. Though it's very common and efficient, from an operating perspective and from a legal ownership perspective for sponsors and for equity owners, it has really come under focus and the target of creditor committees in bankruptcy, which paint the operator as an easy target for litigation. Such litigation claims made against the operator entity is fraudulent conveyance, breach of contract, and breach of fiduciary duty. Our team has worked on both sides, advising both stakeholders on both sides of litigation, both from the company standpoint and as executives of company, as well as on the creditor side. So we've seen both perspectives and strategies on this issue. All right, finally, I want to touch briefly on P&A obligations, as I mentioned earlier, which are also becoming an increasing issue for distressed E&Ps. As commodity prices remain low for a prolonged period of time, companies are forced to shut in wells because they are no longer economic to operate. These inactive wells show up on state or the Department of Interior's, if you have BLM leases, radar. In order to remain compliant with your operator's license, E&Ps will be forced to use precious capital to plug more wells and shore up and put up additional bonding and LCs that require hefty premiums and sometimes personal guarantees by the equity. We are seeing P&A obligations becoming an issue for buyers and rendering assets sometimes unsellable unless the P&A is carved out or the purchase price is reduced. In bankruptcy, state regulatory agencies will oftentimes block asset sales unless there's a clear path of assumption of the P&A obligation by a well-capitalized buyer, or the debtor and the creditors will be forced to settle, to come up with a settlement with the state to address the P&A obligation. Bankruptcy, does not allow, essentially most of the time, bankruptcy does not allow a company just to abandon assets, unfavorable assets under the code. Judges will typically side with the state's and the Department of Interior on these matters to address the environmental liability, and debtors and creditors will need to craft a compromise with the state or face possible conversion to a Chapter 7. So finally, some of the key areas we've laid out specific to distressed energy companies that we see and that we help companies with: liquidity management, assessing liquidity needs, and developing a 13-week rolling cash flow forecast and managing liquidity on a week-by-week basis is critical as you face constrained liquidity and start thinking about kind of broader restructuring solutions. Vendor strategy, as we touched on earlier, developing a strategic communication strategy and managing critical vendors, including negotiating optimal payment plans, will ensure adequate liquidity and help avoid M&M lien filings. Employee retention plans, oftentimes companies going through distress or in bankruptcy, you need to retain key employees and develop incentive plans for management. So our team is very well experienced in developing and benchmarking key employment CURPs or key employment retention plans and management incentive plans with lenders and negotiating with stakeholders, so personnel are properly retained and compensated and also aligned with the overall goals of the restructuring. Liability management is another key area in managing your liabilities, including your funded debt and negotiating forbearances with banks. Preparing operating plans and financial forecasts and other budgets required by the stakeholders, looking at blowdown scenarios and other operating scenarios under the current macroeconomic environment. As we touched on earlier, executory contract review is very critical, especially given unsustainable MVCs and above market rates. So developing a strategy and negotiating with your midstream providers, or determining whether negotiation is not possible and the contract needs to be rejected, or essentially threaten bankruptcy to reject the contract. Cost control and asset sales, selecting and assessing certain capital development programs or other strategies to sell assets, non-core assets to shore up liquidity. Reviewing operating structures, including third-party contract operators and other operating structures to reduce G&A and LOE. And then finally, bankruptcy preparation is there's a lot of prep and time that goes into preparing all the first day pleadings and schedules and other financial reports that are required for a bankruptcy filing, and then also formulating a bankruptcy strategy and a comprehensive restructuring solution. And I think the point we want to get across here is that throughout the process, our team partners with management and serves as a liaison with company counsel, lenders, and investment bankers and other stakeholders. So the management team can really just focus on running the business. So with that, I'll turn it back over to my colleague Damon to discuss performance improvement and preparing the organization for a change.
Yeah, thanks, Dan. I think we have about 13 minutes left here. Not too many slides to cover here, but what I want to share is some commentary we got back from the group of either private equity firms, investment banks, E&P companies, oilfield service companies that are out there, and what we're hearing from them. Obviously, the credit markets, obviously it's unparalleled disruption. That's a direct quote. And kind of what's the impact of the CARES Act and how that will help. That's all being determined for a lot of our clients out there. Private equity guys, they're in challenged situations right now, trying to find a way to preserve their equity. That's a lot of these folks are pretty levered up right now. So that's one area that's of concern for them. From the investment banking side, clients out there, like I said earlier, DEFCON 1, about 50% of them out there, 25% are in kind of a analytical mode, trying to figure out, it's bad, but we'll make it. That's at least their quote, based upon the current commodity prices. And this is all directly focused on E&P, upstream oil and oilfield services. As far as E&P firms go, there's a few obviously that are in crisis management right now. I mentioned earlier, some just can't survive at all in this market. With their costs are higher than some of these commodity prices are in some situations. We expect, and this is another quote from an E&P firm, that obviously M&A activity would pick up in the second half of 2021. That's mostly probably taking out your competition, combining and eliminating G&A. Any way to reduce cost or to get some more economies of scale out there. The markets are expecting that to happen on the back half of 2021, and those could go through some sort of bankruptcy process, be it asset sale, what have you, to take on the assets but not take on the liabilities and kind of the management, the G&A structure they have. Mentioned earlier that several oilfield service firms are in survival mode. That's, several are in very, very good positions, but the ones that have, over commoditized offerings that are not highly engineered, that are smaller businesses, I always call it under $150 million. They're being very challenged right now, especially with the 41% rig count decline year over year. There's just too much supply out there in the oilfield service space, unfortunately. So these folks are doing whatever they can to survive at this point. So these are just a couple comments, not reading every point here on the page from both corporate and the broader community out there that we've got from the folks that we talk to on a daily basis. The next slide here is this general cost reduction strategies that folks are doing before filing. So a lot of this next part of the deck will be focused on the transformation timeline prior to some sort of in-court or some sort of bankruptcy filing, and what companies are trying to focus on prior to having to do that step. Obviously, we talked about CapEx, pause. That goes without saying at this point. That's around the horn, both from drilling completions, gathering facilities, for OFS, machinery and roofline enhancements, IT from a back office point of view, rapid SG&A reductions that's happening right now in terms of furloughs or salary reductions. I have some folks that I know at one of the larger oilfield service companies. They furloughed most everybody below director level for 60 days, and they get half their pay for that time. And that's just an immediate opportunity to get cost out for some of these larger organizations while keeping the business running. Supplier pricing, immediate renegotiation of that needs to happen. Nobody should be paying fuel surcharges at this point. If there's any opportunity to get volume discounts, people need to try to pull those forward, or companies are trying to pull those forward at this point. Driving cash from other sources. That could be, unfortunately, selling stuff below cost just to create some liquidity, extending out payment terms on the payable side. Obviously, that has a cause and effect because you get cut off from a supply point of view. Sale leasebacks are probably a little bit harder to do at this point, or maybe their values are getting cut, and just getting rid of inventory that they can at a very very low below par discount in a lot of these cases, unfortunately, for most of the equipment that's not made to order and not highly engineered, more commoditized equipment. And then lastly, operational efficiencies. All five of these points you'll see on the next slide. All these or strategies that are being taken prior to doing a filing, being more efficient with less people, getting rid of overtime, deferring maintenance on your equipment, whatever that may be. Obviously, that has an effect down the road as well too. That can increase downtime. Working single shifts. Those are all strategies right now that are being taken. There's probably no reason to work two shifts in some of these cases. I'm not talking drilling, but I'm talking more of the manufacturing side of the equation. Maybe working 4 days a week versus 5, but generally being more efficient when they're planning kind of their manufacturing cycles or drilling and production operations. Page 36 here. These are areas that we focus on with our clients. Obviously, liquidity management, cost control, which I just talked about, operational, and then stakeholder management. These are all levers or triggers or points that folks are focusing on that we're helping folks kind of drive with their management teams. I won't touch on all these points here on this slide, but you'll see some on the next slide and kind of our transformation timeline. If you go to page 37, Brett. So this transformation timeline, this is somewhat generic, not specific to any sort of upstream oil and gas company, but we have 3 different areas we look at: is pre-distress, early distress, and kind of right before you're filing, late distress and insolvency. So you obviously see the indicators here across the middle horizontal. And pre-distress, obviously, commodity prices are impacting us quite a bit right now. Credit ratings are changing for a lot of these companies right now, and you have challenge working capital management. So some of these strategies I talked about from pre-distress point of view is really focused on your cost rationalization, operational efficiencies, a lot of the points I talked about earlier that you can do in a market that hasn't really come off the tracks yet. And more of the early distress, the middle chevron there, you're starting to see a lot more rapid SG&A reductions, or working capital optimization. I mean, you're micromanaging your collections and your payables and payroll. This is, in a lot of cases, people are going to these quote unquote 13-week cash flow models where you're doing daily cash management with a small group of people from the ARAP and a kind of SG&A point of view. And then the last part is right probably before a filing happens is late distress insolvency, where you're working with your lenders to create a plan, much like Dan talked about, possibly a prepackaged plan with your lenders, or maybe some sort of alternative asset sale. So you're getting ready to go into that cycle, preparing for the filing. So the next set of slides will focus on what do you need to do to prepare or prior to petition filing. There's a lot of steps that you obviously need to take. Dan covered a lot of them: getting first day motions ready, determining what your strategy is. What I'm going to focus on here is obviously some more of the strategic type of items that you need to do prior to filing. Obviously, you need to get your cost in a sustainable post-petition kind of silo, if you will. So you need to start thinking about what you need to do when you do file for an organization. What headcount you need to keep keep your operations remaining. What back office headcount you need. What projects you need to pause. Obviously, at this point, you're going to have suppliers that are critical to your business. A lot of these are going to be unsecured creditors. But you really need to start determining what is your pre-petition book going to look like, meaning any sort of liability where you're taking possession of goods or services. So there's a lot of pre-work that you need to do prior to filing petition from a systems point of view, from preparing for how we're going to operate, how you're going to operate as an organization, and then identifying opportunities after you do file, where you start executing on those opportunities to begin the reorganization cycle. So the next slide here is, so you have your prior to petition or pre-petition, so far prior to filing Chapter 11 or Chapter 7, whatever sort of bankruptcy filing you're going through. In a reorganization scenario, obviously you're looking to optimize your working capital. A lot of this could, throughout the cycle, you could be selling inventory or assets, reducing your costs, like we talked about earlier, and then planning for what does the future look like. Some of these reorganizations, there is an opportunity to leverage some technology. Maybe you're combining your business with another business in certain situations. I've done that in carve-out situations. And then you need to get ready to execute whatever your plan of reorganization is, assuming it's a Chapter 11, in a post-emergent cycle. And that's maybe you're having to manage your business differently. Obviously, during the cycle, when you are a filer, you're having to provide monthly reports to the courts and to the maybe an unsecured credit committee, equity committee. So there's a lot of reporting. There's a lot of information that needs to be provided to the outside parties during the cycle, but you're also preparing the plan for how you're going to emerge from the bankruptcy and execute that plan and get everybody to agree on that, so you can move forward with this court process. Let's go to the next slide. So this is really at the end, obviously, human capital, business process, technology. This is a lot of the areas that when you merge, you may have to change, you may have to run your business differently. Depending if you are Chapter 11, you're not doing an asset sale or combination. So these are just some of the areas that we look at, is preparing an organization for what it's going to look like when you come out of bankruptcy, improving on price strategies and cash management and how you manage your business, and really resetting your metrics for your plan, your business plan. And then, if there's an implementation of IT to be more efficient, to do more with less when you come out of bankruptcy. That's an area where a lot of our clients, especially on larger enterprises, are leveraging technology to be more efficient, to do less manual processes, to have faster cycle times or less touch points, and whatever sort of back office or even front office process that folks are doing. So do more with less is really the idea there from an IT point of view. Next slide. And this is just our generic approach to performance improvement. This is not, again, specific to oil and gas, but really the four areas that we look at is revenue enhancement, overhead management, obviously the working capital piece, and then direct costs. So these are driving earnings, cash, and your costs at the end of the day that we look at when we're going into a project. This is both healthy and unhealthy environments, but areas that are pretty much covered throughout the life cycle of one of these sort of bankruptcy challenge situations. So from there, I'm going to hand it back over to Brett and see if we have any questions that we can answer for you.
Thanks, everyone. And I know we're butting up against time, so we'll hang around and answer everyone's questions here. One that we got, is on the slides going to be available, and we will make the slides and presentation available after the presentation is done. So I'm not sure if everyone can see my chat box or not, but a question here on 363. Would you assume asset prices sold through 363s will sell at a substantial discount to what they would have sold last year, like PV8 strip or PUDs or just PDP?
Yeah, this is Dan. I think what we're seeing in current 363 sale situations is similar to outside of court sale situations, in that typically buyers right now are really only paying for PDPs, and we're seeing discount rates on PDP assets of around, I'd say, 15 to 20%. Depends on if it's gas or oil heavy, and depends on the basin. But I wouldn't say that because it's in bankruptcy, it's trading at a discount to anything outside of bankruptcy.
And then on top of that, how are mineral owners treated in 363, and can bankruptcy eliminate payments due to the royalty owners?
No, typically mineral owners or your interest owners, the leases and the contracts are assumed through the sale process. So you still owe, I guess, current royalty payments on those in order to keep the leases and contract, JOAs active through the sale process. The only only if there's significant, I'd say, age suspense balances or due to bad addresses or lost contacts or title issues, if those claimants do not file a proof of claim in the court, sometimes those debts can be extinguished through the bankruptcy, and the assets are sold free and clear of those.
Great. There's quite a few non-public companies, and some that are in pretty good position that don't have any debt and just are kind of holding on in the current environment. Is there anything that either of you guys can say to them, in the current environment?
Yeah, and Damon, feel free to jump in. You know, for if there's still, you know, I think that, you know, for those companies, operational implementations and transformations will really help weather the storm. Focus on liquidity, focus on a lot of the points that Damon made, and I'll let him jump in here. I think another key point is you know, taking the time to review your contracts, especially your midstream contracts, and determine whether, you know, on the outside of this, you're going to see a lot of bankruptcy filings, and you're going to see a lot of your competitors filing for bankruptcies in order to renegotiate contracts and MVCs and other things. And so you want to be competitively positioned, you know, when these companies start emerging with more efficient operating structures, that you're in a competitive situation with them, and that, you know, strategically you've done, you know, what you could, whether outside of court or you utilize the bankruptcy code to make your business more efficient. I'll let Damon jump in for more probably operational initiatives to focus on.
Yeah, I think what we're seeing here is everybody's kind of passing the pain down to their supply base. I think most folks want to avoid bankruptcy if they can. Obviously, the suppliers will want to avoid it as well, because they'd be, you know, most of them would be unsecured and have to go through a process, and that can constrain their liquidity as well. So now I've seen a lot of producers out there pass a, you know, 25% immediate ask down to their supply base to get some costs out of their business, and that's the benefit of everybody, and it's temporary. But that's needed for these guys just to keep a pulse at some point. Obviously, you know, some of these folks are worried about liquidity from an OFS level, meaning, hey, is that liquidity going to get tied up in a bankruptcy, or is that going to create this snowball effect? So anything that this industry can do as a whole at this point to pass the commodity decline to all their service offerings in a temporary state is helpful.
Great. Kind of in the PE-backed space, what are you guys either seeing, or what do you foresee in the sponsors doing when their companies are entering kind of troubled times? Do you see them, you know, filing for bankruptcies within the portfolio, or trying to roll up portfolio companies within the fund?
I'll take a first stab and then hand it to Dan. Obviously, sponsors are going to be in the equity position for the most part, and they're trying to avoid the bankruptcy as much as they can. So they're typically doing, you know, cost reductions, things that we talked about earlier, hiring third-party firms to help them implement some of these cost reductions or operational efficiencies, or help them renegotiate their lender arrangements. And that's where I'll hand it over to Dan to talk about that a little bit more.
Yeah, you know, we're seeing oftentimes sponsors, you know, implementing smash codes or combining assets under one G&A structure management team. That's one strategy, you know, in addition to operational improvements that Damon mentioned. You know, bankruptcy is one strategy, but, you know, the sponsors want to maintain control of their companies, and outside of court is always the preferred scenario, to try and restructure outside of court if possible. So, you know, selling non-core assets is another way to shore up liquidity in the short term as you renegotiate with your lenders, and potentially inject more equity into the business to help, you know, help restructure, reorganize that outside of court.
Great, thank you. I guess last question we've had submitted here: is it always advisable to retain senior management in a Chapter 11 filing, even if they're primarily responsible for creating the issues that brought about the filing? Or what are you guys seeing in terms of management retention when going through the bankruptcy process?
Yeah, you know, a lot of times it's critical to maintain certain key individuals just to help facilitate the restructuring process. Now whether those individuals will be considered in any form of a management incentive plan on the back end of a reorganization will be up to the future stakeholders of the company, whether that's the future lenders that are now going to control the equity and be on the board of directors. And essentially that's through a negotiation, that process on, selecting, who's going to be, primary kind of personnel through the restructuring process on the back end is a negotiation and an analysis that we undertake with equity and with the management team and essentially with whoever the new stakeholders of the company are going to be. But oftentimes you need key individuals, key employees to help execute the restructuring and get through the court process and outside of court, and then on the back end, it's determining what the optimal management structure is going to be. And oftentimes your plan of reorganization will kind of dictate what it looks at, what the company's going to look like on the back end. And sometimes it could be a credit bid situation, or the lenders have control and they bring in their folks, their kind of management teams or contract operators or other various strategies. So I'd say it really depends in those situations.
Great. I guess one last question here. Do you guys have any insights, if we're not going to recover here into the back half of 2021, as to how much manpower the industry could potentially lose, and then what the lag would be to get, the manpower, back and maybe retrained in the industry?
Yeah, I'll take a shot at that one, Brett. I don't think we know what it's going to look like in terms of how much we're going to lose. I'd say a good 25% to 30% is probably a bar that we can set right now. I think what we're going to have here, how long this lasts, will dictate what kind of folks we're going to need to retrain to bring back in. Obviously, from the college ranks, we're probably not replacing a lot of new graduates with that are coming to engineering jobs in this marketplace right now. Similar to what we had in the 80s and 90s. But I don't think from a skill set point of view, we're going to have to. It's going to be out there. It's going to be available. There's a lot of these folks that are 1099 or contractors anyways that go from job to job in some cases. So I think those are somewhat folks that are going to be on the bench and available. I think it's more your technical trade, more your engineering type, or some sort of trade that's requires more training. That as we reduce our workforce further, it will be harder to kind of get that program up and going again, because there's a learning curve to climb. But I don't think we're gonna see stuff, the declines we saw in the 80s and 90s, where we just don't have anybody that's coming into the workforce out of college and replacing individuals that are leaving the workforce.
Great. I don't see any other questions submitted, so I'd like to thank everyone for participating in the webinar today. Thanks to BKD and Moss Adams, our sponsors, and thanks to Andy to facilitating, as well as Damon and Dan for presenting. If anyone has any other questions or anything for us, please reach out. Our contact information is here in the presentation, and stay tuned for what's happening next month for the breakfast or webinar breakfast, I guess. Thanks everyone, and take care.